Hello, welcome to Brothers Wall Street. It's a channel related to market, finance and investment. Before we start, please note that this video is for entertainment and educational purposes only and does not constitute financial advice. Today our main topic is the basic concepts of investing. We'll also cover the three magic questions of investing: what to buy, when to buy, and how long does it take to buy. Investing is a way to grow your money over time, but it comes with risks and potential rewards. Always do your research and understand the market before making any investment decisions. Remember guys, investing involves risk, so only invest what you know and what you can afford to lose. Investing is about 20% consistent buying and 80% of active management. As an investor, you can buy daily, weekly, monthly, or even yearly. Personally, I prefer monthly buying as it allows me to focus on my other daily activities. The active management aspect took me 10 years to learn and master. It involves skills in portfolio rebalancing, hedging, dividend reinvestment, and cutting losses quickly. I believe in the saying, the first losses are the smallest losses. So, how long does it take time to grow your portfolio? Well, growing a portfolio takes time, effort, and consistency. It will likely take years to outperform the market. However, with this channel guidance, you can grow your portfolio faster. If you haven't subscribed yet, please do so and give me a video some like. Thanks. As an investor, you have various options to invest your hard-earned money, such as in stocks, bonds, crypto, ETFs, real estate, commodities, CDs, and more. Some are more volatile and risky than others. In this channel, we'll only focus on less volatile financial types with high return potential and to outperform the market. To be successful in any market, whether it's stocks, crypto, bonds, or others, it is crucial to know all the players you're competing with. Understanding who moves the market is essential for long-term success. It's not just about supply and demand. It's also about accumulation and distribution by institutional investors. Institutional investors are large entities such as institutional banks, institutional hedge funds, mutual funds, pension funds, and brokerage companies that trade large amount of securities on behalf of their clients or themselves. This financial institution can influence market liquidity and create significant price movements. The largest players are institutional funds or asset managers, who control other people's money. Generally speaking, there are two types of market participants: institutional investors and retail investors. Retail investors, on the other hand, tend to trade in smaller amounts and have less influence over the stock prices than institutional investors. They may also lack the knowledge, discipline, or expertise to research their investment and may be vulnerable to emotional reactions. IRA and brokerage accounts are two types of investment accounts with different purposes, tax treatments, contribution limits, and withdrawal rules. Which one you need to choose? It depends on you and your life goals. An IRA account is specifically designed for retirement savings. However, at the same time, you're allowed to engage in investment activities, buying and selling different types of investments. However, there are some rules and restrictions to it. IRA account offers tax advantages to save for retirement. There are different types of IRAs: traditional IRA and Roth IRA, and each one with its own rules and tax benefits. IRAs have annual contribution limits set by the IRS. For example, in 2023, the minimum contribution limit for traditional and Roth IRA is $6,500. A brokerage account is a general investment account used for buying and selling various types of investments such as stocks, bonds, mutual funds, ETFs, and other securities. It doesn't offer specific tax advantages like an IRA, and there are no specific contribution or withdrawal limits for brokerage accounts. You can invest as much or as little as you want at any time. In my own example, I chose a brokerage account because it gives me more flexibility for my long-term goals and margin trading for my speculation portfolio. After you have figured out what type of account you need to have, It's time to create your own portfolio with diversified financial securities. I highly recommend starting your portfolio with cash, ensuring it consistently represents at least 20% of your total investment. It doesn't have to be consistently held in your brokerage account. You may choose to keep your money in a local bank savings account or bank CDs for higher interest rates. Allocate 40% to dividend and value stocks with a high reputation, stable income, and over 10 years in the business. For example, consider investing in companies like this you see on the screen. Dedicate 15% to bonds with 2-year or 5-year notes. Due to the high government debt, it's very risky to keep now 10-year or 30-year bonds for the long term. The government debt has already surpassed $30 trillion, and it will continue to rise over time, which increases the chance of potential default. Allocate another 15% to commodities. Instead of buying raw materials or agriculture products, consider investing in commodity ETFs that track the performance of gold, silver, copper, wheat, crude oil, gas, coffee, sugar, etc. Allocate 10% of your portfolio to cryptocurrencies, specifically Bitcoin and/or Ethereum, for long-term investment. I personally invest in Bitcoin because it might go up to 550K, and Bitcoin is a cycle-driven currency now. Today, Bitcoin is more than just a cryptocurrency. It has evolved into a commodity that represents digital gold. I accumulate Bitcoin through monthly purchases of a specified amount to gradually build a position in these digital assets over time. Portfolio management is the skill of managing your financial assets properly. To stand out from all other investors, you need to learn and master this for managing strategies. It starts with finding the right and correct investing strategy. Diversification is a fundamental strategy that spreads investments across various asset classes, industries, and regions. A diversified portfolio can provide more stable returns and guard against unforeseen market crashes. By investing in a diverse range of assets, such as stocks, bonds, real estate, and commodities, investors can benefit from different sources of return and protect against significant losses in any single market. Each quarter, companies pay their shareholders dividends as a portion of their profits. Instead of cashing out this money, dividend reinvestment allows investors to buy more shares of the same company, creating compound interest, where reinvested dividends generate additional income and boost your investment over time. Portfolio rebalancing is the method of relocating money. Rebalancing involves selling assets that have outperformed well and buying assets that are underperforming to maintain their desired allocation. Growth investing strategy is the most favorable strategy for investors all over the world. The main concept of growth investing strategy is to focus on investing in companies that are expected to experience substantial growth in their earnings and revenues. Growth investors seek out businesses that have the potential to expand their operation, market share, and profitability at a faster rate than overall market or their industry peers. Stocks like Apple, Microsoft, Nvidia, Tesla are boomed this year despite negative macroeconomic data. It is important to note that growth investing is just one of the several investing strategies. Individual investors should also consider to invest in dividend, value, or income investing strategies. The dividend investing focuses on investing in dividend-paying stocks to generate a steady income stream. It can help you generate passive income and compound your returns over time by reinvesting your dividends. Dividend investing also requires careful selection and monitoring of dividend stocks to ensure their sustainability and growth potential. Value investors seek out undervalued assets that have solid fundamentals but may be temporarily out of the favor with the market. The idea is to buy these assets at a discount and hold them until the market recognizes their true value. Income investing is a strategy that focuses on generating a steady stream of income. It is all about to receive regular cash flow typically in interest payments, dividends, or rental income to meet current financial needs. It is important to note that while fundamental analysis is often associated with long-term investing and value investing, technical analysis is more commonly used for short-term trading and momentum strategies. Ultimately, the combination of fundamental and technical analysis can enhance an investor's decision-making process, leading to more well-informed investing choices and potentially better portfolio performance. Fundamental analysis is financial analysis based on companies' earnings, performance, and financial data. It is a valuable approach, but is not flawless, as company insiders might manipulate it. They could present higher profits on earning reports that do not reflect the actual situation, or engage in accounting manipulations to reduce debt or perform other actions. Similarly, technical analysis is also beneficial, also not entirely precise. Professional institutional investors have the ability to manipulate it easily. They can execute various movements, create breakouts, and form patterns according to their desires. This can lead to situations where you maybe believe in an uptrend while it is actually a downtrend, and vice versa. Remember, knowledge and understanding are the keys to successful investing. Stay informed, stay curious, and always do your due diligence. Happy investing! And if you like this video, please give me a thumb up. Thanks.